Good evening, everyone. Welcome to our weekly webinar, Let's Trade Live, 29th May 2017. This is Wayne, Head of Research and Education. Warmly welcome everyone to our webinar. So as usual, the webinar will be divided into three segments. The first segment will look at some of the key events or news that has happened in the past 1 week. Second segment will move on to the calendar to look at any upcoming data to take note of. And finally, we'll move on to the charts for the final segment to look at potential trading opportunities. Feel free to type in your questions. I'll take the questions along the way. So let's jump straight to it. For last week, one of the key event is basically the FOMC meeting minutes. Of course, we saw the market selling off the US dollar immediately after the meeting minutes. Even though they have highlighted the tightening is still in progress, but unfortunately the market is disappointed in their hawkishness. So at this moment, it is Fed is in a tight spot, as in their buy is quite high, as in their market is expecting them to raise 2 more rate hike in the second half of 2017. So if they meet that expectation, even in that situation, the dollar may not rally as much. So not to mention if they sort of disappoint on this expectation, there could be a significant sell-off in the dollar. So that's why it is I would say the dollar is in a tough position now. So of course, in the third quarter or the fourth quarter, things may turn around, but it's too early to tell. But as of now, that is the sentiment. So market has already almost priced in a certain rate hike in June. And of course, it is coming soon. If Fed doesn't increase another 25 basis point, there could be significant sell-off in the dollar. That's point number one. Point number two is if they proceed to increase their interest rate, there may be little movement. What the market will be looking out for is in their forward plan. That means when would the next rate hike after that be, or the third rate hike for 2017. So that is basically the situation now. Of course, in the week of FOMC, the next FOMC, of course, we'll talk more about it. But that's the current sentiment at this moment. So having said all this, we do expect the US dollar to be weak for this week. The only possibility for the US dollar to turn around would be end of the week non-farm payroll data. Of course, later when we move on to look at the calendar, we'll talk more about it. Okay, the next event is OPEC meeting. So as expected, OPEC extends their deal for another 9 months. Okay, so last year they made an agreement to limit the production, so they kept the production. Limit the production means there's no more increase in production, meaning they maintain status quo in the amount of oil they are pumping. So now the latest agreement is they're going to extend it for another 9 months. So of course, after the OPEC meeting, we see a sell-off again in the oil. So this is telling us that the market is disappointed in the decision. Market is looking beyond more than just extending to 9 months. So they want to see more effort from the OPEC to reduce the production even further. So unfortunately, OPEC did not make that decision. The only decision they made is to extend their agreement for another 9 months. So of course, that being said, we do expect the oil price to, after this, to maintain unless there's a fresh catalyst to either push the oil price higher or lower. So if some of you are interested to trade the crude oil, later we can look at the oil prices based on the requests. And the third interesting news, this is not really a data as per se, it's just a news from the China Central Bank. So as you can read the headline, China considers changing yuan fixing formula to curb swings. So these are the policies. So I'll do a quick summary of what is this about. Of course, if you want to know more about this changing of or possibility of changing the yuan fixing formula, you can read up our weekly market research, which is published on our website today, just a few hours ago. So very quickly, what is this yuan fixing formula? Of course, it is not in place yet. As you can see, China is still considering changing that formula. Effectively, how it will affect the Chinese yuan and indirectly affecting other Asian currencies and also in particular the US dollar as well. So China being the second largest economy in the world, of course, if any policies that will affect its currency will definitely have a ripple effect to other currencies around the world, especially those in the neighbor and those country that has a lot of trading activities with China, typically like Australia, New Zealand, or even Singapore. So this, how would changing the yuan fixing formula to curb swing, basically what China is wanted to do is to reduce the amount of influence from market forces on the yuan volatility. Because if the yuan is fluctuating too much, it is not good for the country in terms of both import and exports as well. So it is very difficult for, let's say, the country to manage their inflation or even look at how to so-called implement certain policy to boost economy. Because when currency fluctuation is very high, one moment it is strengthening against US dollar, example, and then a few days or week or 2 weeks later, it is weakening against US dollar in a big significant way. Government can't be changing policies that quickly. So this is, from our point of view, we view that this is a good move in terms of stabilizing the volatility of the yuan. Because yuan is being the currency of the second largest economy in the world, just to emphasize it again. So this fixing of formula basically in a way will so-called minimize the yuan appreciating against the other currencies except dollar. So if you read our weekly market research, it mentions that if the US dollar is strengthening, basically it will be maintain the stability of the yuan against the other currencies. So yuan will not follow the strength of the US dollar and start strengthening against currency. And if the US dollar is weakening, the yuan will follow the so-called dollar stability. Of course, it will follow the movement of the US dollar and start to weaken against the other currencies except the dollar. They will move in tandem. So that's effectively how this changing of the yuan fixing formula will affect the yuan. So this is at the back of our mind. So just take note, if China chose to implement this, then possibly we could see this effect on the yuan against the dollar and also the other major currencies. So next, very quickly, we move on to the calendar for this week. Most of the so-called significant data are scheduled to be towards the end of the week, Thursday and Friday. So on Thursday, as you can see, UK is releasing the series of PMI, the first one being the manufacturing PMI. So the sterling has been under so-called pressure due to political and geopolitical and also attacks from terrorists and things like that. That definitely will have an impact on the country's currency. And things are not looking well, as we know that UK is scheduled to hold their election next week. So at this moment, it seems like Theresa May is losing a bit of favor from the ground because of the things that are happening. But at this point, we still see that the chances of Theresa May winning is still there. It's just that they are losing a bit of favor. It doesn't mean the result will swing to the other side. So of course, from now until the actual election, any release of, let's say, poll results, if it shows that there's a trend, the Theresa May party is losing favor, then that could add selling pressure on the sterling as well. So let's look at the data. Manufacturing PMI, market is expecting 56.5 healthy growth. So if there's a slight drop from the previous number, previous is 57.3, so the current one, they are expecting 56.5. So our suggestion is a pending short on pound dollar if the actual number falls below 55. So that means the slowing down is more than what the market expected. So because like I say, when there's a series of bad things, you add one more so-called negative news, that will cause a bigger fear and could spark another round of sell-off in the sterling. So that's the so-called reasoning behind our suggestion over here. On Thursday night, you will see, of course, the news is at 4:30 Thursday, GMT plus 8 time zone, which corresponds to China, Malaysia, Singapore time zone. So at night, 8:15, you will know that it is a ADP employment change. So for us, we decided not to give any suggestion for this ADP because it is too close to the actual non-farm payroll. It is Thursday night. The actual non-farm payroll is actually the next day. So market may choose to wait for the actual non-farm payroll instead of trading the ADP, which is known as the so-called leading indicator to the actual non-farm payroll. So even if there's a very good ADP, market may have some reservation and wait for another 24 hours for the actual non-farm payroll. So that's the reason why we did not give any suggestion for ADP employment change. Then we move on towards the end of the week, Friday. And in the afternoon, 4:30, again, this is the second PMI from UK, which is the construction PMI. Again, market is expecting a slight drop in the construction sector for UK as well. Previous number 53.1, the current one is expected to be around 52.6. So again, our suggestion is pending short in the event that the actual number is less than 51.5. So this is our suggestion. So as long as the actual number is below 51.5, it will fulfill our criteria for this pending short pound dollar. And at night, 8:30 p.m., this is a bit tricky. We need to look at these three data at the same time. So our suggestion is a pending long dollar yen, expecting trading in the direction of good data. So we have seen the dollar being sold off. So if the data really outperform what the market has expected, possibility we will see a short-term rally in the dollar. So this is our suggestion pending long on dollar yen. It has to fulfill 3 criteria, so it is a bit tough. We know that, but there's we can't discount that is what the market is looking for this time round. So the first one is basically the unemployment rate. So if the unemployment rate is less than 4.5%, which is the same as the previous number or better, that is the first criteria. The second criteria is the average hourly earnings, which represents their wage growth. It has to be greater than 2.4%, which is the same as the previous number. So as long as the actual number is the same as the previous number or even higher, that will fulfill our second criteria. And of course, the third and final criteria is the actual non-farm payroll itself. Market is expecting 183k jobs added. So the criteria, if it is greater than 199k, meaning it starts with the 200k or more. So that is to us is a psychological thing from a 1 to a 2 kind of thing. So as long as the non-farm payroll actual number is 200k or more, that will fulfill our third and final criteria for this pending long dollar yen. Okay, so that's about it for the calendar for this week. Before I move on to the final segment, there is a question on my screen: how the US reduce the balance sheet affect the gold price? Very good question. When US reduce balance sheet, basically it will sort of offload their treasuries that they are holding back to the market. So if they do that, it is in layman term, it's also a form of tightening. So if they do that, whenever a central bank tightens, US dollar strengthens. So we know that gold price is sort of highly inverse correlated to the US dollar. So if a US dollar strengthens, there's a good chance that the gold price may drop along with the strength of the dollar. Okay, so before I move on to the charts for any trading opportunities or trading suggestions, this is our accelerator bonus. Get up to USD 10,000 for free. So do check out this promotion, fullertonmarkets.com/promotions. Terms and conditions apply. The next announcement, this is the email that was sent to all our clients, just to highlight based on the feedback that we received during our Fullerton Leaders Summit held end of April in Bangkok. This is one of the change that we want to implement. Basically, our oil symbol contract size used to be 10 units. So it means that the lot size is quite big when you enter a trade. So sometimes may not be able to enter the trade that you want because the contract size is too small, 10 units. So we have taken that feedback and increased the contract size from 10 units to 100 units. And the symbol will be called WTI USD. So during this transition period, if you have entered trades in the symbol oil USD, you can close it. However, with immediate effect, since as you can read over there, from today onwards, you cannot enter trades in the oil USD chart anymore. You have to open the WTI USD to trade the WTI crude oil price. So for those of you who are still holding on to your old positions, you can still hold on and you can close it anytime you want. So until all our client's position is closed from the old symbol, then we will decommission it from our MT4 platform. So effectively, they are the same symbol, same price. The only difference is the contract size. So meaning to say, if you used to trade one lot in oil USD, now when you switch to the WTI USD, you have to trade 0.1 lot instead. Okay, the next announcement, also good news for all our traders out there, and this was feedback that we received from Fullerton Leader Summit as well. So we have taken the feedback and implemented after evaluation, and this is to lower both our margin call and stop out levels. So our previous margin call and stop out levels are set at 80% and 50% of margin level. So this email is being sent out to all our clients. So effectively, we have the example over there. As you can see previously, when let's say when our margin call is at 80% and stop out is at 50%, when your equity reaches 1,000, based on the example shown, all the positions will be closed automatically. And based on our new changes, when our stop out level is changed to 30%, your equity level has to reach USD 600 before the MT4 platform will automatically close off all your trades. So this change will give added flexibility to our traders in terms of managing their open positions. So that's so much for the updates, and we are moving on to the final segment. Let's go to the charts. So feel free to type in the request, what symbol or currency pair that you want me to look at, and the time frame as well. So I'll take on as many requests as time permits. So if some of your requests I'm unable to so-called take care of it, then apologize in advance. So let me switch to the MT4 chart. Okay, while you are typing in the request, very quickly I will review my suggestions 2 weeks ago. So the first chart that we have looked at 2 weeks ago is basically the dollar yen chart. Vertical line is the time of the webinar. So the trade call is because of the double top formation, we are expecting a reversal in trend. So our suggestion is wait for price to close at 113.25 or lower. That would be our signal to go short, and stop loss suggested is just above the neckline at 113.65. So stop loss can place around 113.85. So as you can see, after the webinar, it takes this is a 4-hour chart. It takes almost 1 day before it fulfills the criteria of a candle over there where my crosshair is. A candle that closed slightly below 113.25 for a short. And the entire move over here is close to 300 pips, as you can see my crosshair. And this would be a good move for if some of you have taken this trade. It will be a good move because there's no retracement, no big retracement. So for those of you who so-called utilize trailing stop, it is really a good news for you. It keeps on going down and down and down, and chances is most of the traders who employed trailing stop will get stop out during this retracement over here when the price bounce up. It may be exactly 111.50 or plus minus. So effectively, there's a potential of about any trader who use trailing stop for this trade can easily profit about 170 pips. So of course, some of you may say, Wayne, teach me a method to take the full 300 pips. It is quite, based on my experience, quite unrealistic in a way to determine the so-called tip over here of a turn. So to me, I have learned throughout the years, in the full move over here, if I can take about 70 or even 60, just 60% of the full move, it is considered very good already. That's the benchmark that I set for myself. So that's the dollar yen. So I hope some of you have considered this and taken this trade as well on your live account, and this could be a good profit. The next chart that we looked at was Aussie Kiwi H1 chart. Given two suggestions for you to consider. One is when price closed at 10783 or higher for a long. But for this trade is a bit not so favorable in my opinion, because the risk reward is not that fantastic. So after entry within less than 20 pips, 15 pips, you will hit the resistance. And for me to put a logical stop loss, it will be below the support, which is almost 40 pips. So the risk 40 to 45 pips, the risk reward is like 3:1. 3 risks versus 1 reward. Then the second suggestion is wait for the price to hit the support around 1.075 and bounce up before taking a trade for a long. So if some of you have taken this suggestion and decided to enter this trade, who feel that this is a good entry, you will see a doji over here, a typical reversal candlestick, where my arrow is. Of course, some trader who would like to wait for another confirmation. After the doji, price may continue downwards. So if a trader who wants to wait for another confirmation, a bull candle, and then enter at the third candle over here, okay, at the opening of this candle, where my arrow is pointing to. So typically you put for this kind of trade, you can put a stop loss slightly lower than the last low, which is about 18 pips, and the final the target is let's say below the resistance, so that is about 37. So 18 pips versus 37 pips, is the risk reward is almost reverse. It's 1:2 instead. 1 risk versus 2 reward. So again, for Aussie Kiwi, I hope that some of you have managed to catch or caught this trade and take some good pips out of it as well. The third chart that we have looked at is basically gold over here. Okay, the vertical line is the time of the webinar. So the first signal I mentioned is when price close at 1236.50 or higher, that will be the signal to go long. And next one is a short. If price close at 1231, that would be my signal to go short. So of course, the price, after it retraced downward, it failed to go further down due to the dollar weakness. It went up. So it triggered my entry for short. Hover there for about 5-6 hours and start to retrace upwards. So this one I have hit my stop loss for this short trade. And of course, the other way around, it triggered the buying criteria. It broke out from the resistance to trigger my entry. The candle has closed way above over here for entry to go long. So again, this was that if someone who have employed trailing stop in this gold trade, it would have taken quite a nice profit, because the retracement is wasn't very huge to hit any trailing stop. So the only chance of hitting the trailing stop maybe is around 1255 level, when the price retrace. So if someone has taken this breakout long trade, typically the potential is about 1,750 points, which means that if you have traded one lot on gold, 1,750 is equivalent to 1,750 US dollar on one lot. So that's basically gold, one losing, and make it back when it reversed and broke the resistance. The fourth chart is basically euro dollar. Again, the time of the webinar. So I mentioned the entry if the candle closed above 109730, possibility going for a long. Stop loss can consider at 1.0960. Just this is a very tight stop loss, just below the consolidation. So if it hit, is a small loss. This is only a 13 pips or 14 pips or 15 pips stop loss, very small. And after entry, it just shoot all the way up with very minimal retracement. So one of the possibility is again hitting a stop loss over here when the price retrace. So possibly the trailing stop could be hit at about 1.1086 or even lower, 1.1083. Again, this is let's say for this trade is about 20 pips stop loss for a potential gain of over 100 pips. Very good risk reward. The fifth chart that we look at is pound yen. So pound yen is there was some volatility in the sterling. So we have heard of an unfortunate event. So the volatility was caused by the unfortunate event. But based on 2 weeks ago, the so-called trading suggestion, one is to go long when candle close at 147.03 or higher. Didn't fulfill this criteria for long. Then the other two suggestion is a short. One is when candle closes at 146.25 or lower. That would be my criteria to go short. And the other criteria is when price retrace to 146.85, look for a turn before going in for a short. So of course, because of this volatility over here, as you can see the tail shooting way beyond it. So for traders who have placed of your stop loss over there, it would be the case whereby you hit by market volatility. This kind of situation, sometimes you ask me how to avoid, because there's no way to foresee the unforeseen circumstances. Your stop loss is there to protect you. If it's just a once-off event, you lose this much with proper money management, don't be bothered about it. You could be just risking 2%, 3%, and then it is just 2-3%. You have more other profits to wait for in future trades. So this is a stop loss. If you have placed a stop loss over there, hit by market volatility, move on to other trades. Final charts that we have looked at is basically the pound dollar. Of course, pound yen and pound dollar both encounter the same volatility in so-called due to the sterling. So again, for pound dollar, there were two suggestions. One is a short candle close at 129.136 or lower, going for a short. So the price really went down about close to 30 pips and then retraced back to an entry price after almost 12 hours or more. And then the other signal is to go long when candle closes at 1.2939 or higher. Okay, so that would be that is the last chart that we have looked at 2 weeks ago. Okay, let's look at what is past. We look forward. So the first request on my screen is basically, oh, there's a lot of requests on euro dollar. Good. Euro dollar is very trending at the moment because of the expectation, divergence in expectation of the central bank. So US Fed is in a tightening cycle, but market is expecting them not to tighten as fast because economic data is showing slowing down and things like that. And then of course the other side, very interestingly, ECB is saying that they are not considering tightening, but market is sort of hopeful that they will start to tighten soon. Very interesting. So there's a divergence in terms of expectation of what the central bank is doing. So on one side, market is expecting ECB to tighten. It is not that ECB wants to tighten, it is what the market expects. So this is another classic case whereby the forex market or the currency market is traded based on expectations. And the other side, of course, market is expecting Fed to slow down their tightening. So there's a so-called divergence in terms of expectation. That's why you see the euro dollar heading in an uptrend. So the request, most of the request is for 4-hour chart. Okay, so let's look at the euro dollar 4-hour chart. Okay, this is what the euro dollar looks like now. So I'm going to zoom in so that it is easier for all of you to see it on your screen. Very nice so-called conversion region over here. Okay, let me 1.1165. That's the region. Okay, this is the current candle. So market is finding a sort of a support for it. So typically this would be a long setup now. My kind of long setup, you see a bullish engulfing pattern just formed in the last 2 hours, sorry, last 8 hours. 2 candles is 8 hours. Where my green box is. Okay, let me zoom in further. You could see, yeah, this is what I mean by bullish engulfing. So by right, the entry price would be, my entry price would be the opening of the candle, which is at 1.11826 exactly. Yeah, 1.11826 plus minus 1 pip is fine. So market is slightly above now. So I have a habit, I don't like to run after the market. So for this trade, my potential stop loss would be somewhere here. Okay, below the region. Okay, I'm going to mark the price in red as well, red for stop loss. So stop loss is about 40 pips for easy calculation. So just below about 1.1145 plus minus. So if I do a measure, there's 2 choices that I can make. One, I will put a pending order. Price now is 1187, which is about 5 pips higher. So the first scenario, first choice that I can choose is I put a pending order 11 at 11826, and then I set my stop loss and my target. So my stop loss typically is about 38 pips, and I can set my first target to be 38 pips as well. Alternatively, the other option that I have, since it is not too far off from my entry price and factoring the pip spread, if I enter now, chances is my stop loss is about 45 pips, and if I take 45 pips, it will be somewhere here. So it is 1:1, still not too bad. So in this case, I may choose to just do instead of putting a pending order and wait, I may choose to put a instant order and set a 45 pips stop loss and a 45 pips for my first target. Okay, very just to highlight the short term immediate ceiling that I see, very short term. When I say ceiling, it doesn't mean that market will definitely reject from this level. It's just that market may pause and then decide where it wants to go. So this is the immediate so-called decision area that I see, 1.1230. So once price hit into that will be, I'm expecting market to make a decision whether to go higher or come back down. So having said that, that means that could be the area of my first target where I will choose to either exit partially and shift my stop loss to my entry price to protect it, or I may choose to exit totally. So this would be a suggestion to go long, and it has fulfilled my entry criteria. So that's the euro dollar. The next suggestion on my screen is pound dollar. Great, let's look at pound dollar. And the other request on pound yen as well. So I will take a look at both of these pair together. Of course, both these pairs, there's a certain correlation because both are sterling pairs, and this week we are seeing two sterling important PMIs releasing on Thursday and Friday to watch out. The request for these two pair again is also 4-hour chart. Okay, I'll just switch both to 4-hour chart. Okay, what I'm doing now is to try to see any how's the correlation between these two pair in this so-called short period of maybe 1 month or so. In the last 1 month, how's the correlation like? Okay, both are 4-hour chart. Okay, the correlation is only strong in the last maybe 1 week or 1.5 week. Over here in the last part where you see the pound dollar dropping, the pound yen also dropping. But before that, pound dollar is actually heading in a sideways motion, whereas the pound yen is actually heading in an upward trend. And the most recent one, prices is ticking up. Sterling is strengthening against yen and also strengthening against dollar. So the only factor at this moment that will affect the correlationship between the pound dollar and pound yen is the non-farm payroll. Non-farm payroll, so-called impact, that will affect the strength of the dollar, but not the strength of the yen. So other than that, if you look at the UK manufacturing PMI and UK construction PMI, both these data will have the similar impact on these two pairs that will affect the sterling. So when you decide to take positions on these two pairs, do watch out and manage your risks accordingly. Especially you are shorting both pair or buying both pair. So for pound dollar H4, okay, because of the geopolitical risks and the upcoming uncertainties in the upcoming election, I do see the sterling, relatively the sterling is slightly weaker as compared to the US dollar. So my suggestion would be consider going for a short. That is what I would do. The immediate resistance 1.2850. If the price doesn't break above, you start to retrace, look for a bearish engulfing pattern before going for a short. And depends on where is the shadow of the last high. So estimate the stop loss could be somewhere in this region. Okay, this is just an estimate because for me I need to see the shadow of the last high prior to entering the trade to decide where is my potential stop loss. I will take a reference from the last high and set it higher, maybe 5 to 10 pips higher to take care of the pip spread. So again, depending on the formation of the bearish engulfing pattern, the entry may be around 1.2835 maybe. So these are just estimate. It depends on the bearish engulfing pattern for a short. So of course the first milestone or the first target is over here. Once the price goes near to 1.27, about 9.5 plus minus. Okay, once entry price goes towards 1.2795, once it is within pips away from it, so that would be the first milestone to decide whether to close off the position entirely or just close it partially, and then shift the stop loss to entry price to protect the rest of the positions. So this is what I would do for pound dollar. And the next pair would be the pound yen over here. It has a similar shape, trend coming down and price is retracing upwards. So my suggestion would be similar, but for yen it needs to retrace higher based on the price action. 143.60. That would be the area that I'm looking at. So price has to retrace higher, a bearish pattern, before I would considering going for a short. Okay, that would be a pound yen for me as well. Next, I'm going to look at gold. Okay. So before I move on to gold, I would like to, maybe some of you can amuse me or encourage me a bit by saying that you have made some pips out of the trade suggestions that I have made 2 weeks ago. Can I have a show of hands? Show of hands as in you just type. If you have made some profit out from the trade suggestions that I made 2 weeks ago, kindly type on my screen. No worries. I won't ask you to treat me for dinner, or I won't ask you how much you have made. It's just a form of encouragement for me for what I'm doing. So as long as I know that whatever I'm sharing is helping at least some of you, if not all of you, to grab some pips out from the market. Oh yeah, I see some yeses. And I know some of you are shy to express it. It's okay. You send some signal to me, I'll be able to sense it. Good. Thanks for the honest reply, and I will continue to share my best and hopefully help all of you grab some pips from the market as well. So let's move on to gold. Yes, gold chart. Gold chart H4. Yes, the request is H4. Okay, let's look at the H4. I'll erase all this H4. Okay, this is gold chart, very big trending move downwards, and now it's reversing up, consolidating. Seems like it is breaking for new high, but the break wasn't very strong and convincing. I'm referring to this part of the chart. So after it broke the resistance, it failed to rally further and start to consolidate. So that's why I mentioned the rally wasn't as convincing. So I'm going to zoom in. This is the overall picture. So I'm zooming so it's easier for you to see the candlestick. So apparently after the break from this resistance 1263, okay, and market is now in a very tight consolidation over here. So I personally would prefer, instead of the H4, it seems to me H1 may be a better, or rather H1 may give me an earlier entry. So let's, I'll switch to H1 and take a look. Oops. Okay, so this is H1. I'm going to zoom in. H1. Okay, price is sort of consolidating, seems to be consolidating over here. I will put some price label first. Okay, the boundary is about 1269 to 1265.50. This is just $3.50. Very tight range over here. So for those of you who are trading gold, you will know that this is actually quite a very tight range. It is almost like 5 to 10 pips on a currency. So having said this, the first suggestion is actually based on technical. If some of you are considering shorting the gold after when price close here at about 1264.50 or lower, okay, let me put a vertical line for the current. Okay, based on this tight consolidation over here, my signal for short would be if the candle close at 1264.50 or lower. That would be my typical criteria to go short. However, I would also take into consideration, because on the H4 time frame, this is the so-called support that I'm expecting. So after shorting within like less than 150 points, it will hit into sort of the support already. So it is not a very good trade for me in my trading plan. After I short, it straight away hit into a support region. To me, that is not really a favorable trade for me. So I would prefer the other side. If candle close above 1269 so it has to close at 1270 or higher to fulfill my criteria for long. So that's my goal. That's how I see gold. So I put my comment over here for the short. So that's my opinion for the short. And fundamentally, it's pointing to at least a weakness in gold. The only turnaround, like I mentioned, is non-farm payroll. So if non-farm payroll is a good number, then possibly we could see the gold heading downwards. Okay, so one final pair before we end off tonight's session. EuroCAD daily chart. Okay, let's look at the EuroCAD daily chart. Okay, we rarely look at EuroCAD actually. So this is interesting. Let's look at EuroCAD. This is H4 time frame. Uptrend into a consolidation on H4. Request is to look at daily chart. Let's look at daily chart. Okay, daily chart, it is in uptrend over here. Since mid-Fed onwards, Euro has been strengthening against the loonie. And of course, for the Canadian dollar, because of the drop in oil prices, it is suffering a bit as well. So based on the last OPEC meeting, they're going to extend 9 months, but that's about it. So unless OPEC do more than what the market is expecting, if they announce something like they want to reduce the production level, then that could prop up the oil prices and give the loonie a boost. But for now, unless the Canada economy is showing a good so-called data and things like that, then that's the only way for the loonie to strengthen. But if you pair it against euro, I have a better so-called hope for the euro, because at least the market has the expectation that ECB could tighten towards the end of the year. So at least for this week, if you look at it, I still foresee the euro has a slight edge over the loonie, at least for this week. To trade the daily chart, it is a bit challenging at this moment. If you look at it, the candlestick over here seems to have a nicer formation on lower time frame. Just by looking at this last 10 candle on the daily chart, on lower time frame may form some very nice range for us to have some trading opportunities. So if you ask me, I would prefer, instead of waiting for the daily chart, which is in this case, sometimes I would wait for daily chart, because if daily chart presents a nicer pattern, I would choose the daily chart. But in this case, I'm foreseeing maybe the lower time frame will have a nicer chart for me to trade. Let me see if I visualize it correctly. So I will confirm by switching it to a lower time frame, H4 chart over here, or even slightly lower H1. Let me see. Okay, seems like H4 has a nicer pattern. I'm going to H4. Okay, this is H4. Let me mark the boundary that I'm seeing. Okay, this is the middle. Okay, let me put some price label over it. No wonder, there's a round number over here, 1.51. Another round number up there, 1.52. And this is 1.5025. Okay, just give me a moment. $1.5025. Okay, these are the three so-called decision region that I'm looking at for EuroCAD. So price has bounced off from the support of 1.5025, and there's a pretty strong bull candle over here, followed by a doji, and this is the current candle. So price is now is slightly retracing downwards. So if you ask me, this is still a buying signal for it, a predominant uptrend. entry price is actually now, because it's actually for me would be now. This one there's no option whether to put for me to put pending order or not, because it's lower than my intended entry price for a long. So in such a scenario, for me it would be a instant execution for a long in this case. So I need to calculate my lot size and my stop loss. So for this case, my stop loss will be somewhere around here, just below the, slightly below all the shadow, which is around another round number over there. Around 1.5, that will be my stop loss. So if I go long now, my stop loss is about 45 pips, and the first milestone, as you can see, before it hits into 1.51, I have about 50 pips to play with. So even for the first milestone, I have easily more than 1:1 risk reward, 1:1.1 or something like that. So to me, this would be following my trading plan for going along. So of course, if you look at euro dollar and euro CAD, the correlationship may not be strong, but if there's any market so-called catalyst that will move the euro, whether strengthening or weakening it will still affect these two pair in the same way. So having said this, that means you have, if you choose to enter euro dollar and go long on euro CAD, long on both pair, you have to manage your risk as well. So there is a chance that both your trade could be hitting stop loss or profit at the same time. So that will be a euro CAD for me. So it is already giving me a buying signal in this case. Well, time flies. We have come to the end of the webinar. So if I can't take some of your requests, my sincere apologies. So this is Wayne signing off. I hope that the webinar has been beneficiary to you. Whatever I shared will set you up nicely for a week of profits again. On behalf of Fullerton Markets, I thank you everyone for your kind attention, and I look forward to seeing all of you next week, same time, same channel. And this is Wayne signing off. Good night and bye-bye.